Hi, Nick Bullish from DataTrek here, and today's video is about how to think about the value of gold, the price of gold. And I'd like to start with a personal story about this topic, actually. My family is originally from Cuba and came here in 1960, just after the revolution. And because they kind of missed the timing of getting out of the country early, they didn't have any money when they came here. They were quite wealthy there, but they basically came here with $200 in a suitcase. And that taught them a big lesson. After they got back up on their feet, my dad started buying gold coins, on a business trips to Europe mostly. And he'd buy 1, 2, 3 ounces a year. That was $35 to $37 an ounce, so it was an affordable purchase for him. And he just wanted a store of value where, if for some reason the U.S. became unstable, which is how refugees think, no place is safe, then he at least would have something to start a new life in another country, and another country after that. So he viewed gold as a long-term store of value. This is like back in the 60s. In the 1970s, the price of gold began to increase pretty quickly because of a couple of things. The first was in 1971, President Nixon took the US dollar off the gold standard, and prices began to rise. And then in 1974, it became legal for U.S. citizens to buy gold coins and gold bullion for investment purposes again. It had been illegal since 1933, so demand rose even more. And then in the late 70s, inflation really took over as a big investment theme, and the price of gold went up even further because gold was viewed as an inflation hedge. So gold went from $35 an ounce when my dad was buying it in the 1960s to $600 an ounce in 1980. Now, that was just about the time I was going to college. So my dad was able to pay for my entire college education with some of the gold that he had stacked over the course of the prior 20 years when prices were extremely low. And I got to go to college without any kind of student debt, which was fantastic. So gold helped me do that. So I think about gold prices a lot and what makes people interested in gold. And I think my dad's experience is fairly emblematic. You don't necessarily have to be a refugee to understand that gold is a store of value. This is actually one of the gold coins that he bought very late in the early 1980s, and I got to inherit. Now, over the last 10 years, gold hasn't done as well as the 70s, obviously. Gold's compounded annual return is roughly 5% a year for the last decade, and that's not as good as the S&P. The S&P is up 13% a year over the last decade, so by that measure, gold's not been as good as stocks. But if you look at stocks outside the U.S., the story is different. The MSCI All-Country ex-US Index is only compounded at 5% a year for the last decade. MSCI Chinese equities have only compounded at 3%. So yes, gold hasn't done as well as the S&P, but it has absolutely held its own versus non-US equities on a total return basis. So when you think about gold versus stocks, understand that there's more stock markets than just the US, and gold has done reasonably well against stocks outside the US. Now, let's take a step back and talk about where gold supply and demand is right now to kind of start putting this into a useful framework for thinking about gold prices going forward. The supply of gold, and this data comes from the World Gold Council, excellent website, by the way, if you want to look into this topic more in depth. They have great databases. The supply of gold is roughly 75% from new gold mining coming out of the ground every year, and 25% from recycling, just recycled gold in various forms, jewelry, other things. And that's the supply of gold every year. It's about 4,700 metric tons. The demand for gold comes from 3 places primarily. First is jewelry demand. That's roughly half of all demand for gold globally. 25% comes from investment demand, coins, bullion, ETFs, things that people buy to own as an investment. And then 25% comes from central banks, not the US obviously, but non-US central banks do buy gold for their reserves. Over the long run, last 10 years or so, demand for gold across the board has been fairly flat, 0.4% growth annually a year. However, over the last 3 years, all the incremental demand for gold has come from central banks, specifically China, Turkey, Russia, and India. They have been big net buyers of gold, and you got to ask yourself why. Well, I think they see in gold what my dad saw in gold, which is 2 things. The first is gold is priced in dollars, and the dollar is still the global reserve currency. So you kind of get backdoor dollar exposure when you own gold as a non-US holder, because you're owning something that is priced in dollars. If you want to buy gold in India or China or Russia, you can show up with local currency, but you have to translate that into gold in dollars in order to buy the gold you want. There's no pricing in a local currency. It's all anchored to the dollar. So owning gold is like owning the dollar plus the volatility of the underlying assets. The second thing, and I think is even more important, honestly, is once gold is in a central bank's vault anywhere in the world, again, Russia, China, India, Turkey, it can't be confiscated. This is unlike financial assets like treasuries, which, as we saw with the Russia situation after the invasion of Ukraine, financial assets can be confiscated. So gold has the benefit of not being able to be confiscated, if there's geopolitical tensions. And that's important to a lot of these central banks, because they've seen what happened with Russia, and they're interested in having reserves that are based in dollars, but aren't subject to U.S. sanctions or U.S. confiscation or Western confiscation. So those are two important benefits, and they're not going away anytime soon. So let's wrap up. The picture for gold over the next couple of years looks pretty good, honestly. You have underlying decent demand from jewelry demand. As long as the global economy is good, jewelry demand should be strong, so that'll hold in. And then you have this incremental buying from central banks, which doesn't seem to be going away anytime soon. Now, if you think we're going to have an outbreak of global peace, then gold's probably not a great trade, because central banks will see much less interest and not want to own as much gold. However, the current situation feels quite different. We have geopolitical tensions with Russia, with China. Turkey has its own issues. India is a growth economy and doing pretty well, but it's a very gold-based economy, and so they should continue to buy gold as well. And then you have the whole de-dollarization theme, where yes, gold is still priced in dollars, so it's not really de-dollarizing a central bank's balance sheet, but it is taking it away from the financial asset side of the dollar and into real assets. So the bottom line is we're pretty bullish on gold for the next 5 to 10 years. You have good underlying demand, good incremental demand from central banks, and it's also a very good diversifier for global portfolios, financial asset portfolios. Gold tends to trade differently from stocks and bonds over time, except in the most sort of dire crises when everything just goes down. So it's a good thing to own, and we tend to recommend to clients a 3 to 5% position in a big diversified portfolio be in gold. So that's our take on gold. I hope you found it useful. As always, please like and subscribe if you found this information of use to you, and please do check out the DataTrekResearch.com for more information about us and our product offerings. Thanks very much, and have a great day.